In this video we are going to talk about dividend growth stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. Investing in stocks with a strong history of dividend growth is a good way to protect your portfolio against huge swings in the market. These stocks can also operate as a hedge against economic or political uncertainties, in addition to market volatility. These, on the other hand, provide downside protection due to the fact that their payouts are increasing with time. Aside from that, the outstanding fundamentals of these firms ensure that dividend growth is a high-quality and prospective investment option over the long run. These include a long-term profitable business model, rising cash flows, adequate liquidity, a robust balance sheet, and some value attributes, among other things. Furthermore, the company's track record of excellent dividend growth indicates that additional dividend increases are likely. A history of dividend increase year over year, as opposed to a portfolio of just dividend-paying companies or firms with high yields, results in a healthy portfolio with a larger potential for capital gain over the long term. Despite the fact that these firms do not necessarily have the greatest dividend yields, they have outperformed the larger stock market and any other dividend-paying stock over a longer period of time. Target Corporation, ticker TGT. Target is the highest yielding choice on the list, as well as one of the lowest yielding options accessible. Dividends paid on stocks are only 1.4% in today's market. It is critical to emphasize, however, that there are two difficulties that must be thoroughly examined. To begin with, despite the fact that Target is a smaller company, it generates a somewhat higher rate of return than the S&P 500 as a whole. Target's dividend yield has also fallen dramatically in recent months as a result of the stock's enormous growth in value over the preceding year. Having a problem like that isn't necessarily a bad thing. As a consequence of a significant $7 billion digital investment that began in 2017 and continues to this day, the company has been able to increase its competitiveness in an increasingly e-commerce-centric world. In 2020, customer demand changed to organizations that could manage online food and basic supplies, and Target was able to satisfy its pandemic needs because to the prior investment. Target has been able to capitalize on its strong profitability trend throughout 2021, resulting in consistently good quarterly results. Grife Incorporated, Gef. Grife is the smallest company on this list in terms of size, but it has the most clout in terms of power. The packaging materials and containers manufacturer, as projected by the firm, would be in the right place at the right time in 2021, allowing it to seize possibilities. Demand for a wide range of packaging materials has increased as a result of increased customer demand. Grife's revenue increased by 38% in the most recent quarter when compared to the same period the previous year. Furthermore, earnings considerably above forecasts by a wide margin. The firm has been strained by rising input prices, such as the price of wood pulp. Grife was able to raise pricing to address these issues, which was a major success. Grife expects to profit from unprecedented levels of consumer spending in the United States. It also makes the following distributions to its stockholders. According to Investopedia, Gef stock is currently yielding 2.6% on an annual basis. Grife Incorporated, ABBV. Grife is back on the list of the best dividend stocks after making the cut in both 2019 and 2020. In the previous 2 years, the company has made the cut. It's easy to understand why this is the case. Grife stands out as an attractive investment opportunity because it is a unique dividend stock in a market when dividends are hard to come by. It's an excellent investment because it's one of the healthcare industry's highest-paying stocks. Grife is unique in that it gets the vast majority of its sales and profits from Humira, the company's most profitable and successful product. In fact, that drug has been the best-selling pharmaceutical product on the market for many years. Bears will point to the company's risk of losing market share if Humira's patent expires in a few years, as they believe it will. The company expanded its product range by purchasing the rights to other medications like Botox, which allowed it to grow. The stock is currently yielding 4.8%, and given that the stock isn't expected to expand in value significantly in 2021, now could be a good time to buy. Johnson & Johnson, J&J. In the United States, Johnson & Johnson is an example of a blue-chip stock. In general, the company's revenue and earnings grow by a small percentage each year on average. The firm boosts its dividend payout each year by a large amount to thank its stockholders for their continuous support. Furthermore, it has grown its dividend payout for 58 years in a row, making it one of the few American dividend kings, stocks that have increased their dividend payout for at least 50 years, that are now traded on the stock exchange. J&J maintains a tremendously diverse healthcare organization under a cohesive corporate structure as part of this strategy. The consumer products industry sells everything from Listerine and Tylenol to Pepcid and Band-Aids, among other items. The company's most successful business division is pharmaceuticals, although it also distributes medical devices and other items. As a result of the outbreak, hospitals will be unable to provide elective treatments in 2020. After removing that roadblock, the company will be able to get back on track in 2021, making it an excellent time to invest in the company's current 2.6% dividend yield. Iron Mountain Incorporated, IRM. In the sector of document and data storage and security, Iron Mountain is referred to as a real estate investment trust, REIT, which is short for Real Estate Investment Trust. Investors were concerned that a reduction in the use of paper documents would have a detrimental impact on the company's bottom line, therefore the company has been in a downward spiral for some time. Managers, on the other hand, have switched their focus away from traditional services like phone and data communications and toward digital services like data backup and data center operations. Iron Mountain stock, on the other hand, has recovered from its recent lows and is on track to set new highs in 2021. Stockholders, on the other hand, continue to be rewarded by the company, which currently offers a 5.2% dividend yield. One element that contributes to this is the REIT structure. Due to their legal structure, real estate investment trusts, REITs, are able to avoid double taxation on their income, yet they are required to distribute at least 90% of their profits to shareholders. This arrangement has benefited Iron Mountain stockholders, and it has proven to be mutually beneficial. Discover Financial Services, DFS. Discover is one of the highest-yielding credit card issuers in the market, earning them a spot on this list of the greatest dividend payers. Despite paying a dividend return of only 0.5%, slightly higher than the rate on a regular bank savings account, Mastercard Incorporated, MA, is the world's most profitable company and pays the highest dividend yield. Discover how Discover shares can help you to increase the value of your money. As a result of this policy, Discover maintains a fairly low payout ratio of 20% in compared to its earnings, allowing the firm to enhance its dividend in the future if necessary. Anyone who has had exposure to the credit card industry at this time should take use of it. The government and the Federal Reserve provided unprecedented economic stimulus in response to the flu outbreak, shattering all prior records. As a result, consumption has increased. In the year 2021, it looks that people are beginning to appreciate the better things in life, which will lead to greater spending on household appliances, household items, travel, and experiences. As a result of this growth, Discover and its competitors have seen a significant increase in profits. According to the business, Discover shares are currently trading at just 8.8 times expected earnings. Mondelez International Incorporated, MDLZ. PepsiCo is one of a number of food and beverage companies on this list, which also includes a number of others. There's also Mondelez, which makes Oreos and Toblerones, as well as Halls, Trident, and Tang, among other things. Sales increased considerably in 2020 as a result of the pandemic, which prompted people to hoard food for their families. As the benefits of the tax cut fade and inflationary pressures on the cost side materialize, stocks have begun to decrease in value in 2021. Price increases will not be allowed by a food behemoth like Mondelez, which will emerge stronger than ever from this difficult period. Over the last year, the stock has only gained in value by a small amount, making it a good investment. Meanwhile, the company pays a respectable 2.3% dividend on its stock. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.